Hey guys, I want to talk about Nvidia. Guys, this is a bubble. This is a bubble. I mean, look at this thing. I mean, this company was growing for 20 years and it looks like it didn't move for 20 years. A 4 cent. And then at the end of 20 years, it went to $5. I mean, I guess these are reverse splits and everything else, but you can see it, 10 cent to $6. Now we're talking a $3 trillion market cap. A P ratio of 71, which means it would take you 71 years to get your initial investment back. This is price to earnings. This is and they're only earning $1.70. Earnings per share is $1.70. And out of that $1.70, 40 cents of that is a dividend. So let's say, all right, so I take my $1.70 profit, I pay out 40 cents in dividends. So what does that leave me with? $1.30. Let's say, okay, I invest. I would say I'm the company CEO or something, and let's say out of that $1.70, 40 cents goes to dividend, which leaves $1.30. 30 cents just gets wasted. It's a big company. It's a big. 30 cents just goes to waste. And let's say I reinvest $1 every year. I mean, if I'm reinvesting $20 maybe, if I'm earning $20 and I'm reinvesting 15 of that, yeah, maybe you could grow this fast, but you're paying $120 today to earn $1 next year or $2 next year. This is not a good investment. And look at the 52-week range, $38 to. I mean, I don't know if this is after a stock split or what, but this is ridiculous. This is bonkers. And look at where we're trading today prior to the pandemic. You forget the world is $300 trillion in debt. We're not having any children around the world. Who's going to pay the debt? all the young people are drug addicts and drunks and people, that want disability or on the side of the road with a help me sign. Who's going to help them? All the people that are working, they're working 2-3 jobs just trying to make ends meet, just trying to pay the rent, trying to pay the mortgage, trying to buy food, and they have no savings left over. This isn't just a bubble. This is a mega bubble. And if I had to bet, I would short the fuck out of this shit. I would short it all the way back down to 40. Because that's where it's going. It's going back to 40. So, what's that, a 400% loss or something like that? No, a 300% loss. Or no, 200%. Maybe 50. Maybe stop shorting at 50. But yeah, this is a bubble, guys. This is a mega bubble. It's going to take you 70 years to get your money back. So if you invest today, it's going to take you 70 years at these earnings. I mean, you're only making $1. You're getting a 40-cent dividend. You're paying $120.89 today to get a 40-cent dividend next year. And maybe $1 on top of that. But you don't actually keep the $1. That dollar goes, all you get is the 40 cent. The other dollar, like I said, 30 cents is just going to be wasted. It's a big corporation. The CEO is going to take that money, or someone's going to be trying to steal from the company, or it just goes to waste. It's a big company. Maybe someone steals 20,000 rolls of toilet paper or 20,000 rolls of paper or something. It just gets wasted. Maybe someone is using their company vehicle too much or something. I don't know, but it just gets wasted. So you only reinvest in $1. So the only time investing in a company like this would be a good idea, in my opinion, is if their revenues, if their earnings were like growing like 170% like year over year. They're trading at 37 times price to sales. They're trading at 60 times price to book. They're trading enterprise value to revenue 37 times. Enterprise value to EBITDA 58 times. I mean, they do got a high profit margin. They do got a high return on assets, return on equity. Their revenue is 79 billion. The market cap's 3 trillion, guys. I mean, this isn't even profit. This isn't even 79 billion in profit. All right, let's say they do make $30 billion. If they can consistently make $30 billion a year, and their market cap is 3 trillion, no, this is bad. In order to be like a 10% return, they would need like $300 billion of $300 billion in profits to justify this market cap. So instead of like a 10% return, you're maybe getting a 1%. And probably that most of that 1% is probably right here in this 40-cent dividend. Think about it, guys. If you buy a house for $200,000 and you get $20,000 in rent, in theory, in 10 years, that house would be paid off, and everything past that would be profit. So we're talking trillions here. So instead of 30 billion, you would need $300 billion of profits, not revenue, but profits. Their revenue is only $79 billion. And that's not even profit. I mean, a lot of people can't wrap their head around trillions because it's not an everyday number like a dollar or 50 cents or something like that. But yeah, just for my example, if you make a real estate deal and you buy a house for $200,000 and you're going to rent it out for $20,000 a year, it would basically take you 10 years. $20,000 the first year, $40,000, $60,000, $80,000, $100,000, $120,000, $140,000, $160,000, $180,000, $200,000. It would take you 10 years. Now, it'd probably take you more than that because you're probably going to pay a bunch in taxes and land value, and assuming the land value doesn't double or anything like that. Let's just say the land value stays the same. But yeah, to have a market cap of $3 trillion, you would need profits of at least $300 billion a year to for the next 10 years, to have a 10% return. If you can get a 5% return today just from treasuries, just go buy a short-term treasury note or a long-term treasury note or whatever you want to get, you can get 4 or 5% risk. They say risk free, but I say there's risk still. So why the hell would you want to buy this? And you're not even going to get close to a 4% return. At best, you're going to get maybe a 1% return, or more than likely, you're probably going to get a negative 200% return. You're buying at 120, it's only worth 40. It's probably not even worth 40. It's probably worth like 15 or something. I think this is a horrible investment. Is this a monopoly? No. There's other companies that are in the semiconductor industry. There's a whole bunch of them. And anytime you got profit margins of 50%, just like in the auto industry, they're going to be coming after you until this profit margin shrinks to like 10%. I mean, I'm sure that I mean, I got a $2,000 computer. I got a high speed. You know, I can play the best video games. I can stream. I can do wherever the hell I want. But not everybody can afford $2,000 computers. Or $3,000 computers, or $4,000 computers, or $5,000 computers, or $10,000 computers. You know, the market. You know, 2 years ago I made $100,000, so I could afford a $2,000 computer. But not everybody can afford a $2,000 computer. So, regardless of making the chips or not, who the hell's going to buy it? I mean, yeah, people got to buy the chips before they buy cars. People can't even afford to buy cars anymore. I mean, even the car I bought I got a damn 7 year, it's going to take me 7 years to pay it off. I mean, granted, I'm only paying 4%, which is beautiful, but it's still 4%. It's still debt. Who knows? As much as I drive, I mean, that car may not even last 7 years. I just think this is ludicrous. This is you know, this is buying tulip bulbs. This is quitting your job and selling your house and buying a tulip bulb and hoping that one tulip bulb is going to pay your whole year's salary for one tulip bulb. I mean, how stupid does that sound? But yet this is and I know I love her to death. You know, I got a friend who had gone all in on this, and I think it's going to end badly. And this is one of the first guys I started watching. He likes Warren Buffett. He considers himself a value investor. Seth Carlin, or forgive me for pronouncing his name wrong, but I want to get his take on the shares have potential to rise further 35% from current levels due to the semiconductor equipment makers' key role in the artificial intelligence boom. BOFA analyst, blah blah blah. Is that Bank of America? Yeah, Bank of America. He raised his target, the highest among 40 analysts. To book revenue of $40 billion next year. That's not profit, that's revenue. I mean, you could have $100 billion revenue and still not make $1 billion profit. So to me, the revenue don't really mean shit if you're not making any profit. They are making profit, but it doesn't come close to what they need for this market cap of $3 billion, $3 trillion. So I mean, if you just want a 10% return on your money, so a 10% return says, like, let's say you bought it at $100, and then next year it goes to 110. That's a 10% return. To get that, you would need 300 billion in profits, not in revenue, but in profits. And Yahoo Finance used to have like a little graph down here that had the last few years earnings, but I don't know what they did with it. I guess they took away with it. I think whoever did that is a fucking idiot and a fucking moron, because it was helpful. But anyway, let me shut up and let me listen to. I mean, you got these idiots all the time that gold's going to 10,000, Bitcoin's going to 1,000,000. You know, you got all these pumpers and all these idiots and all these morons. This is a bubble. This is a mega bubble.
Centers to run AI algorithms. This is normal when it comes to investing. The crazier the stock price, the more exuberant are the projections when it comes to what will happen. And that is also pushing the S&P 500 higher and higher. People are not thinking about price. The P ratio is at 27, way above the average historical. Nobody cares because Sven, you're stupid, you're an idiot. AI will make so much money for everyone that it's going to be crazy, and Sven, you're going to miss out on the huge run because you don't understand things. In this video, I want to show you my opinion and why I'm happy to miss out on the AI craze. I'm happy I missed out on the growth stocks craze 3 years ago. I'm happy I missed out on marijuana stocks in the past, bio stocks in the early 2010s, internet stocks in 2000, etc., etc. There is this Brookhill Asset Management that always sends a very nice newsletter, and they say the hell with herd mentality, and I'll take just some of you snips from their presentation. Subscribe if you want to read more about value investing to their presentation. have no connection with them. I just like the attitude they have. So this is me, and well, contrarian, that's what I do, and that's why we are here and you are now watching. Now, profits from the changing AI world. How will AI change the world? Here it is. McKinsey, that should be a very reliable, reputable research company, says that AI could increase corporate profits by 4.4 trillion a year. That is 150% on current profits, according to new research. And how are they going to do it? You can pause this and read a little bit. Everywhere, tech companies will increase profits, generate value 2.6 to 4.4 trillion. And even, for instance, retail and consumer packaged goods companies could see an additional 400 billion to 660 billion in operating profits annually from the use of generative AI. Consumer packaged goods and retail. Now, where is the exuberance here? If you are a consumer packaged good producer and you have some kind of advantage, what do? You lower the price a little bit to gain more market share, to sell more of your products, right? When you lower the price, who is the winner? The customer. So if AI makes everyone so smart, which means the competition will increase hugely, which means the benefits will all go to the customer. Just an example from 25 years ago, how the internet changed the world. Did the internet change the world? Absolutely yes. You're now watching me doing this video. Thanks for watching. Smash that like button. But you're doing that practically for free. It doesn't cost you anything. You pay your monthly flat fee, and that's it. You're using internet. 25 years ago, the price
of
that...
I mention in the background, I see he's got a Warren Buffett book here. He's got this is a Seth Carman's, I think that's Seth Carman. Yeah, Margin of Safety. That book alone is $1,000. I downloaded it for free, but
that would be enormous. And I think Gary Vee mentioned it somewhere that he looked to upload videos online in 2004, and just to upload 5 videos, the weekly price was $50,000. Just to upload. Then for you to watch, it was even higher. And yes, at that prices, which are likely the current pricing situations that McKinsey has analyzed, at those prices, there could be a lot of profits. But what happens when there is so much investment in these things? Prices usually go down. And this is the story, the same story we had 25 years ago. Cisco, yes, it did grow, it did change the world, but investors from there didn't make much money. The Nasdaq Composite from the last bubble, investors there didn't make much money. These are meager returns till now. Yes, if you joined here, you feel a genius, but very often risk can be confused as intelligence in a bull market. Please don't confuse that.
Car, take me home.
Why are the returns not great? Why didn't it just continue to go up? Because of competition. So research doesn't account for competition, for the lowering costs. I will use EI. How can I lower my costs? And this.
And I've said this before, like with Ford, for example. The auto industry is a competitive industry. The semiconductor industry is a very competitive industry. If one company has a 50% profit margin, everybody is coming after you. And they're going to keep coming. Think of it like a fight. I mean, you think you're fighting one person? No, you're the cousin's coming, the brother-in-law, the sister-in-law, the stepson, everybody's coming after you until that profit margin shrinks into basically nothing. And thus the U.S. automakers, they all went bankrupt. And the government had to bail them out. And they still can't pay it back. I've said it before, I'll say it again. Ford loses money on every single vehicle except for the F-150. I may not be a rocket scientist, but to me, if I lose money on every single vehicle except F-150, the only thing I'd be making is the F-150. At some point you saturate the market, and so there's a cap to what people are willing to pay.
This is then a wrong calculation based on just the upside, not thinking about the downside. Because if you just look at the internet transit price,
and one thing I love about the guy Tony Deegan, well, I mentioned him many times, is he doesn't focus on what can go right. He focuses on what can go wrong.
This is 99% down, and likely now we are still even lower. This AI, if it is so smart, the price of it will look something like this, and therefore competitive advantages, yes, for the customer. But there is always the herd mentality. AI will change the world, we have to invest in it. And going to Charles Mackay, in reading the history of nations, we find that like individuals, they have their whims and their peculiarities, their seasons of excitement and recklessness when they care not what they do. We find that whole communities suddenly fix their minds upon one object and go mad in its pursuit. That millions of people become simultaneously impressed with one delusion and run after it, till their attention is caught by some new folly more captivating than the first. Extraordinary Popular Delusions and the Madness of Crowds, Charles Mackay, written in 1841. And just to dig a little bit deeper on that herd mentality, everyone is in the S&P 500. Look at the momentum level compared to the 2000s dot-com bubble. The weight of momentum stocks is at all-time highs, thinking about Nvidia compared to the Nifty 50 of the 1960s, 70s, and 1929. The weight of the largest companies is extremely high, yet history is not on their side. Because companies, yes, grow sales, but if you look at consecutive years, sooner or later that growth subdues because of the competition that I already mentioned. And EBIT margins continue simply to go lower because everyone is after those companies. Big is anything but beautiful. 1957, 2023, top 10 stocks versus the S&P 500. Relative returns are negative. This is the performance of the top 10 versus the other equally weighted. Look at this, negative versus positive. And now we have also the market cap of the largest stock relative to the 75 percentile. Compare it to the years here and you will know the long-term returns. We have now a concentration in tech. Whenever it was like that, the returns haven't been good. And I'll just give you a counterbalance. Buffett's cash pile rose to 189 billion amid scarce deals. So you can call me whatever you want. idiot, whatever, but I'm calling it, I'm saying it, it is a bubble now. I hope it lasts as long as it can for you, but I'm just going to keep doing my compounding irrespective of bubbles succeeding, of not succeeding. That's value investing. And
so yeah, there's my take on Nvidia. So even though they made 80, they had 80 billion in revenue. Pre-tax income was 48 billion. Taxes ate away some. You basically got 40 billion. But look at their profits. $1.74. I don't know why this has their earnings per share at 17. But this has it at $1.70. Okay, so Yahoo Finance is wrong. It should be 17 here instead of 1.7. This has their PE at 7 times. Forward P at 33 times. I mean, I realize these numbers look impressive here. unfortunately, this one only goes back to monthly, but here was, when was COVID back here? I mean, it was $25, and it basically went from 5x from here to there in 2 years. I can tell you where this thing is going to be in the next couple years. It's going to be over here somewhere. It's going to be down here somewhere. Without a doubt. It's not going to continue up exponentially. Even if they're making $17 a share, it's still a horrible investment in my opinion. I mean, let me go back to my DAC example. I mean, according to this, they're making $30 a share. You're only paying $94. You get your money back in 3 years. I mean, when I bought this thing, it was at $2.50. I would much rather be making, if I'm paying $90, $94, I'd rather be making $30 of profits and getting my money back in 3 years. Plus, I'm getting a 3% dividend. I mean, why would you want to pay $120 even if so these numbers are wrong here, because this should be 17, should be close to 20, which will lower the PE substantially, but the market cap is $3 trillion. I mean, granted, they got a little bit of cash. They got $30 billion in cash, but they also got $11 billion in debt. I'd rather than pay the debt off, have no debt, and have $20 billion in cash. But yeah, this is a bubble. This is a bubble, guys. I'd be shorting the hell out of this shit. Shorting it all the way down to 40. Or at least 50. I would not touch it with a 10-foot pole. And I mean, we do the same shit. We did it with Dogecoin. We did it with Bitcoin.
How do you spot a high-performing team? You could analyze how they tackle complex challenges or admire how they meet every deadline. But the easiest way is to simply ask, do you use Smartsheet?
Microsoft reports its fourth quarter numbers.
I mean, to me, if they're making $300 billion in profits, and they're not, they're making $40 billion. So if they're making $300 billion in profits, okay, that's fine. That's a 10% return. The market cap's $3 trillion. They need to be making $300 billion in profits, not 70 in revenue.
Today. Last quarter, AI was mentioned 45 times on that earnings. Bedrock counts OpenAI, Plaid, and Bitcoin in its portfolio, lots of other names as well. But Jeff, we want to talk to you specifically about AI because you were an investor in OpenAI long before ChatGPT came along. So what did you see there, and what did you think with that Microsoft investment?
Absolutely. Well, actually, we did invest back in 2021 when, folks said it was somewhat of a crazy science project or a, sort of team with Sam Altman and the team that he'd assembled was really a shot at being the foundational model, the AI becoming sort of a true societal transformation over many decades to come. So our bet was that they would be related to that core thesis. We're delighted to be investors and quite
things we saw at the turn of the last century.
Yeah, I feel very lucky to have lived through what I believe are now three great bubbles, and back in that bubble, then the crypto bubble of sort of the 2015 to maybe 2020s and everything that launched, really AI bubble. And then the question is, what are the 1, 2, or 3 names that on the other side of this are going to capture point?
Talk really quickly about a couple other companies that you think have similar prospects or good prospects like OpenAI.
I mean, I think there are several investing in our big tech incumbents that are effectively integrating AI very rapidly in markets today. What you want to be investing in are big tech incumbents that are effectively integrating AI very rapidly into their offerings. So obviously I'm on the record as being very bullish Microsoft. I think on this program back in February, I suggested your viewers take a look at Nvidia. I think that one still, even though it's rallied 150% plus to date, I think there's a lot of room for that to run there through core infrastructure. And then really the incumbents that have distribution into businesses, into companies, everything from Oracle all the way on down. I think a lot of these last wave companies are going to really be able to benefit from AI.
Well, that really wasn't what I was looking for. I mean, I've been talking about this bubble bursting for a while now.
All right, now let's head down to the lot where Tom Brady is trying to track down our Hertz customer.
I'm here, Vaughn, but looks people are now convinced AI will change the world. I imagine it will. Every bubble ensues from widespread conviction. Everybody believes A, they bid the beneficiaries of A up to the moon. It turns out it's overdone.
That there's Howard Marks, the founder of Oaktree Capital. Honestly, I love following what Howard has to say because, as you heard in that clip, he has an amazing ability of being rather frank and telling it how it is. The long-term stock chart for each of the 7 businesses we're talking about, and you can notice one thing in common, right? They're all up and to the right, but particularly across the last few years, with the one exception being Tesla. This is because ever since the profound unveiling of OpenAI's
Will be so rapid, you overweight them, and then it isn't. So your large holdings suffer because they didn't live up to expectations.
And that's the argument from a large contingent of the value investing crowd right now. These stocks have skyrocketed over the last few years to some very eye-watering value.
And look, this is my video. These are my videos, a couple of them. I wanted to get back to the original. And I will remind you of this.
And you have
This is, remember he wrote a book on this stuff. He taught valuations at Columbia Business School.
things that are ugly, cheap, boring, out of fashion, small and obscure, or otherwise on the other side of the existing finance industry mania.
If it's on the recommended list of one of the big retail brokerages, my advice to you is watch out.
Value investing consists of a basic approach to the process of investing. The first thing you have to do is identify potential investments that you're going to look at.
What you are looking for is stocks that are obscure. It's stocks that are small capitalization, because big...
But that is my advice. Stay away. If it's on the recommended list, beware. And back when the when the COVID hit, I do love Google. I use Google every day. I love Microsoft. Not for the gaming side, but for some of their other stuff. And I do like Oracle as well. In fact, my long-term stock picks, back then would have been, if I just could pick some big cap companies, would be those 3. Exxon, which at the time was trading at $44, and yeah, if I would have been doing really well, but I'm not I wouldn't be investing in them to get try to ride the wave. I would be trying to buy it cheap and invest for the long term. But I mean, this is crazy. I mean, if you had $3 trillion a day, would you buy this company? Because to me, if you were to buy one share of the company, you might as well buy the whole thing, right? That has to be your mindset. If you're willing to buy one share of this company, you would be willing to buy the whole thing, because basically even one share, you're an owner. There's a lot of people shorting this thing. I love this guy, and he actually, what I do like about him is he'll actually tackle some of these big companies and offer his valuation.
You need to stay ahead in business. Use AI to generate whole new possibilities. With the most experience in the cloud, imagine how AWS can transform your business.
I think for the last few years, it's not just the last year, I think this fixation on what the Fed will or will not do has distracted us from the fundamentals. So from that perspective, I think the less talk there is about the Fed, the healthier the market becomes.
That's unlikely. I guess, is that a function of the volume of Fed commentary, or is the market just primed for that no matter what?
It's the delusion that the Fed sets interest rates that drives me crazy. I mean, the Fed influences rates, but it doesn't set rates. And I think as long as we believe the Fed can do whatever it wants, our investing is going to be, we're not going to invest based on what really matters.
All right, so that brings us to tech and what Nvidia told us this week. And I guess the degree to which some argue they either sucked oxygen out of the room or fed the room oxygen. What's your general take on the space?
I think it's a testimonial to the power of momentum. I mean, right now the momentum is clearly with Nvidia. They can do nothing wrong. Everything they touch turns to gold. And we've seen this with other stocks before. We saw the Tesla in 2020. We saw it with Facebook and Google in the middle of the last decade. When the momentum is with you, nothing can stop you. And right now the momentum is with Nvidia and it's carrying it forward. But if you look at the numbers themselves, the question you got to ask is, what are people measuring these actual numbers against? What are those expectations? Because right now, those expectations seem to be whatever we do, Nvidia will beat it.
Well, I mean, when you talk about the momentum when it comes to Nvidia, the momentum is actually in its business, right? In addition to it being in its stock. And so it seems as if, the market has been growth rates.
That's really the question. All momentum has its source in something solid. In this case, Nvidia's earnings and revenues have blasted through the roof. That said, though, at a $2.5 trillion market cap, you're building in an expectation that either the AI chip market is going to be $1 trillion, which it's not going to be. There's no way that the chip market alone, the AI market might be 2 or 3 trillion, but the chip market cannot be that big. Or you're building in the expectation that Nvidia is going to find a couple of other really big markets to conquer over the next decade. Either way, I mean, it's clearly a possibility, but is it plausible? I don't think so.
Outside of AI, Oswath, how do you perceive the valuation gap in the private markets versus the public markets? We're hopeful and waiting the potential for some IPOs this summer, hopeful from the standpoint of activity down here at the NYSE perhaps, but we keep hearing instances.
The last year and a half, Much of it has been at the top of the ladder, the large market cap money-making tech companies. And part of the reason I think we're not seeing the IPOs that you'd expect to see when tech is doing well is because of that disconnect. That disconnect might disappear if the market keeps doing well. But for the moment, I think that's what's separating the two.
All right, let's see what he said a couple days ago.
Power E-Trade's award-winning trading app makes trading easier. With its customizable options chain, easy-to-use tools, and paper trading to help sharpen your skills, you can stay on top of the market from wherever you are. E-Trade from Morgan Stanley.
Let's talk about Nvidia again.
I mean, this is what I'm talking about, guys. It's heading to 10 trillion market cap. It's already in a bubble. It's already in a mega bubble. $3 trillion company here we're talking about. And they only have profits of 40 billion. They have to have at least $300 billion of profits to even justify this market cap today. And then you got idiots talking about $10 trillion, even 3 times bigger than, I mean, it's just ludicrous.
I mean, you own it, so you should have that big smile on your face. Is it defying logic to you, or just does this make perfect sense?
No, I don't want to sound like a broken record, but on an intrinsic value basis, it's really tough to get to 3 trillion. That said, though, if you were designing the perfect momentum company from scratch, Nvidia would be it. You've got a great story, a CEO who sticks to the story, no distractions, is able to meet expectations in the short term because they've set the game up. And you've got a market that contributes to the mix. I mean, I think that you're seeing one of the great momentum plays of all time playing out in front of you.
Well, are you reevaluating, I guess is maybe the best word I can think of at least now, of how you would view this stock in terms of its value? If you thought it was overvalued before,
right?
What do you think now? And are you looking at it? Is it forcing you to look at it differently?
Oh, well, with every earnings report, you're always required to go back and look at your basic story.
And not only was Yahoo Finance wrong. It said $120, and I don't know if this is post split. I don't know when the split is, but it was $1,200.
Story, and I think my basic story is bigger than it was a year ago, partly because of what Nvidia has delivered, and partly because of what AI is showing it can do in the overall economy and market.
I want to hear this
listening
more.
in the story about HP Enterprises reporting higher up.
What if there was a faster, easier way to build a basket of stocks and ETFs and manage it as one investment? With Fidelity Basket Portfolios, trade baskets with one click, allocate new contributions, and track performance from your personalized dashboard. Click here to get started.
How do we get to this 10 trillion? Is Nvidia becoming the most valuable company in the US, or do we see these other tech giants moving higher along with it?
Yes, and let me remind you that I had said years ago that Nvidia would surpass Apple to become the world's most valuable company. Now it's nipping at its heels.
Oh my gosh. I can't even listen anymore. Guys, short the fuck out of this shit. Short the fuck out of it. Short it all the way down to 50. I'm telling you, this is a bubble of all bubbles. Can I find one person that agrees with me that this is in a bubble? Well, I mean, Aswad agreed that it's a bubble. I would love to hear what he has to say. I don't know who the hell.
The future of your business is here. With Wix, you get advanced AI.
So if you are an Nvidia investor or you're thinking about becoming one and you're a little bit open-minded, then I think this will be helpful. I wasn't going to make this video. I'm not a huge fan of getting myself in the middle of stuff, but I thought this is so important I should. And I've previously made a video in which I've gone through what some might argue is fluffing up of the order book. This is a different story altogether, and it's a little bit complex. So if you only like videos of fluffy kittens, then I'm sorry, this is the wrong video for you. This one's gonna hurt the head a little bit here. So there is my disclaimer at the outset. This isn't financial advice. I am basing this on an article that I've read by a chap called Just Dario. You can find him on Twitter, or X as it's now called, and he's written a very, very good piece, but probably 90% of people reading it won't understand it. And not because they're not smart enough, it's just because there's terminology in there that doesn't mean a lot to a lot of people. So I thought it'd be worthwhile explaining this. So if you are an Nvidia investor or you're thinking about becoming one and you're a little bit open-minded, then I think this will be helpful. Let's dive straight into it here, right? So Felix here, I used to be an investment banker. We run an academy where we teach people how to trade. We've got 3 market makers in our team, and that's important because this is a lot about market makers and what they do. We literally give away our trading strategy. I'm running a live training on Tuesday. It's off with saying, in the last filing, they declared that they repurchased 21 million shares. They paid $9.7 billion.
Which would be good. They're buying back shares, you would think that'd be good.
Through the year. Now, however, they didn't mention how many shares were bought during the quarter, and some might argue that that is a bit of a red flag because it's most unusual. Companies usually always tell you how many shares they bought and at what price they bought at every single quarter if they're doing buybacks. So he said that's a bit odd, isn't it? So let's figure this out. So he did some quick maths, and he basically said they bought 5.1 million shares, paying 2.6 billion. So, all right, is there any problem with that? So far, it sounds good, right? You can figure it out yourself, Felix. What are you complaining about? Well, they paid $527 per share in the last quarter on their buybacks. Now, the average price of Nvidia during that quarter was $492. So they could just be really bad at timing their buybacks, right? They might be forgiven for that. Maybe they're just not that smart with buying, very smart with making chips, not that smart with buying back their own shares. So in summary, Nvidia paid 7% too much to repurchase its own shares. That's not really a big problem. But what they're saying is that there is a category on this document here, it's a little bit too small for you to see, that says there are unsettled share repurchases. Now anybody who's familiar with reading these documents knows that that never happens. Buyback shares, you buy your own shares, that trade is settled immediately, as in the trade's done, it's over. There's nothing to talk about here. When I said there wouldn't be any fluffy kittens in this video, I was not exactly truthful about that one, was I? My chief financial analyst who does all the digging around here. So, okay, what are they doing? How are they coming up with these odd numbers? Well, one explanation would be that they're using options. And it's most unusual for companies to use options to buy back their own shares. And the conclusion Dario comes to, and I follow him on that, is he's saying the $540 share price paid was achieved because they are using call options to do so. So they are using call options to voluntarily pay more for the stock than they would need to. That's a really peculiar thing to do, isn't it? Why would you overpay for your own shares?
Well, this is very oh my gosh, if this is true, this is, oh my gosh. So basically, you got a company that's manipulating their own stock price on purpose. This guy looks like a dork. He looks like the mad scientist on Back to the Future. But I'm so glad I clicked on this video. I mean, if a company is going to buy back their shares, they should be smart about it and buy back at the low price, not overpay. All right, I'm going to shut up and let this guy finish.
Typically, that isn't in the best interest of shareholders, well, except for the ones you bought the shares of. So, how does that actually work, and what's the problem with this? If you wanted to prop up your own shares, and you had a lot of money, the smarter thing to do than buying your own shares, because you would be doing that at the market price, is to buy call options from somebody called a market maker. And how does that work? Well, let me put it on the screen for you here. So how does that work? Okay, so you have Nvidia up here, Nvidia, and they buy.
For a little savings, Specialist Miller buys in bulk. For a lot,
a call option. And the price of that call option, or the strike price of that call option, is $540. You with me so far? Who creates the call option? Where does it come from? Well, there's somebody on the other side who sells it to you, and that somebody is called a market maker. And it's a very unusual job. We've got 3 of those guys on our team, and basically what they do is they create the option out of thin air. They sell it to Nvidia. What do they get for it? Well, they get money. So these guys get money for it, and Nvidia gets the option. Where does that leave the market maker? Well, it leaves the market maker essentially minus, so short Nvidia. So they would make money if Nvidia went down, they'd lose money if Nvidia went up. Given the way the market's going, that's not a particularly great place to be in. So what do? Well, they are forced to offset that short position by buying Nvidia stock. So what Nvidia is actually achieving with this little trade shenanigan, by buying call options, they are actually forcing somebody else to buy the shares. So you can manipulate, one might argue, the market if you have a bit of budget with your call option, and you force the market maker therefore to buy the shares. And by doing it at relatively high prices, well, they're just forcing these market makers to hedge and hedge and hedge and hedge. So particularly, as the stock keeps moving, they just keep having to buy more, basically, because their short position gets worse and worse and worse, right? So the more the stock goes up by, the worse their short position gets. Therefore, they have to buy more and more stock.
Let me go back. Alright. This is pretty damning.
We've got 3 of those guys on our team, and basically what they do is they create the option out of thin air. They sell it to Nvidia. What do they get for it? Well, they get money. So these guys get money for it, and Nvidia gets the option. Where does that leave the market maker? Well, it leaves the market maker essentially minus, so short Nvidia. So they would make money if Nvidia went down, they'd lose money if Nvidia went up. Given the way the market's going, that's not a particularly great place to be in. So what do? Well, they are forced to offset that short position by buying Nvidia stock. So what Nvidia is actually achieving with this little trade shenanigan, by buying call options, they are actually forcing somebody else to buy the shares. So you can manipulate, one might argue, the market if you have a bit of budget with your call option and you force the market maker therefore to buy the shares. And by doing it at relatively high prices, well, they're just forcing these market makers to hedge and hedge and hedge and hedge. So particularly, as the stock keeps moving, they just keep having to buy more, basically. because their short position gets worse and worse and worse, right? So the more the stock goes up by, the worse their short position gets. Therefore, they have to buy more and more stock to offset their position. So it's a funny scenario. You're essentially creating a squeeze up, and it's called a gamma squeeze. It's an options terminology. It's very much like a normal short squeeze, but it's triggered by market makers. And these guys really don't care which way the market goes. They want to be at zero risk. That's their job. Their job is to take no risk whatsoever. And it looks a bit dodgy, doesn't it? It just looks a little bit dodgy. So he's saying here, in the last two weeks of the new year, Nvidia repurchased 2 million shares, not accounting for the current quarter. That around 10% of the total amount of shares repurchased. They're very likely derivative settlements into February, option expiration, and so on. So he's basically just running through here. They are a kind of aggressively squeezing themselves up legally. And is it legal? Yes. Does this happen all the time? Probably. On this scale, with the number one stock of the moment out there, it's a little unusual. And I don't particularly like it. I think management is very smart. I think they're doing everything they can to keep the rocket ship steering upwards, and it's a smart thing to do. It makes everybody wealthy, it makes everybody happy. Does it hurt anyone? Not particularly, except for the short sellers, and we tend not to care about them all that much. But it does give you an insight into the mindset of management, that they're willing to go a little grey when needed, if the allegation is indeed true. And I have to say that, otherwise I have to delete the video even sooner than I intend to. So there we are. Let me know if you find this interesting. If it's too complicated, please ask down below in the comments. I hope that doesn't come across as patronizing, but I know in options world and market makers, and it's not where most people...
Yeah, I don't want my company, I don't want something that I'm invested in, I don't want them doing shit like this. JustDario.com. Anyway, guys, thanks for watching.